Now let us do a problem from Modigilani Miller Hypothesis or theorem. Okay, so let's read the question. AB Engineering Limited belongs to a risk class for which the capitalization rate is 10%. Okay, it currently has an outstanding of 10,000 shares selling at rupees 100 each. The firm is contemplating a declaration of dividend of rupees 5 per share at the end of the current fiscal year financial. It expects to have a net income of rupees 1 lakh and has a proposal for making new investment of rupees 2 lakhs. Calculate the value of the firm when dividends are not paid, that is the first scenario, and when dividends are paid. So basically the question requires you to compute the value of the firm when the firm is paying dividend and when the firm does not pay the dividend. Okay, and you have to do it under Modigilani Miller approach to prove that the whatever be the dividend that you are paying, it is not affecting your firm's value. Okay, so let's do the calculation. Now let's list down what all data what we are having. So first we will take when dividend are not paid. Okay, now when dividend are not paid, you have certain information here. Okay, what is the cost of equity? The cost of equity is given to be 10%. And what is number of shares outstanding? Number of shares outstanding is n. N is 10,000. Okay, and the shares are selling at rupees 100 each, which means it is the market price right now, which is P0. P0 is rupees 100 per share. Okay, then is it paying any dividend? So in the first case dividends are not paid, so D1, that is dividend at the end of first year, it is 0. Okay, now what do you have to do? We will have to compute the, so first you have to find out what is the value of shares at the end of first year. Okay, so value of shares at year 1 end, which is nothing but P1, and we know that P1 is equal to, okay, what is the formula we are having to compute P1? We have P0 is equal to P1 plus D1 divided by 1 plus KE. Okay, so P1 is equal to P0 into 1 plus KE minus D1, that is equal to 100 into, what is 1 plus KE? It is 1 plus 0.10 minus 0, that is equal to 110. Okay, so rupees 110 per share. So that is P1. Now what do you have to do? You have to find out what is the amount that is required to be raised by way of equity to finance the project. Okay, so what is the value of investment? So the investment that is being proposed is 2 lakhs. Okay, now as we already saw, this investment 2 lakhs required will be financed out of retained earnings first. Okay, and balance by issuing new shares. So what is the retained earnings over here? Here the retained earnings is nothing but the total profit that is made, because there is no dividend distributed. Okay, so let's compute it as this way. Earnings of the company is equal to rupees 1 lakh. less dividend paid is nil, because there is no dividend paid. So retained earnings, or it is the profit available for reinvesting, available for reinvesting. So how much amount is available? The same 1 lakh is available. So what is the total amount required? Total amount required is 2 lakh. Out of this 2 lakh, 1 lakh is in the form of retained earnings. So the balance is how much? Again 1 lakh. That will be raised by way of equity shares. Okay. So profit available for reinvesting is 1 lakh. Therefore, balance to be raised by issuing equity shares. By issuing equity shares, that is 2 lakh minus 1 lakh, that is equal to 1 lakh rupees. So you have to raise 1 lakh equity shares. Okay. Now if you 1 lakh rupees as equity shares. Okay. So what is the value per share at which additional shares are issued? Additional shares are issued. See, we have already computed that P1 is nothing but 110 per share. So the shares will be issued at P1 is equal to 110 per share. Therefore, number of shares to be issued, that is delta N. Okay, delta N is the number of shares to be issued is equal to 1 lakh is what we have to raise maximum, divided by 110. So that will give you, what is 1 lakh divided by 110? It will be a fractional amount. So let me take my calculator. It is 909.09. equity shares. Okay. So now if you calculate the value of the firm, that is NP0 is equal to, what is the formula? N plus delta N into P1 minus I plus E divided by 1 plus KE. What is N? N is 10,000, which is the number of shares right now, plus what is delta N? Delta N is 909.09 into P1 is 110, okay, minus what is I? I is the investment required. Investment required is 2 lakh plus E. What is E? E is the, E we have already computed, okay. So E is 1 lakh, that is the retained earnings, okay. So okay, so E is the total earnings for the period. It is not retained earnings, it is the total earnings for the period, divided by 1 plus KE. 1 plus KE means 1 plus 0.10. So that is equal to, instead of writing it as 909.19, I am going to write it as 1 lakh divided by 110 itself. Okay, so or let's put it as 909 itself. Why to complicate? Okay, so it will be 10,909.99 into 110 minus 2 lakh minus 2 lakh plus minus 2 lakh plus 1 lakh is minus 1 lakh divided by 1.10. So if you do this calculation, it will be 10,909.99 into 110 minus 1 lakh divided by 1.1. It comes to almost around 10 lakhs. Okay, rounded off to 10 lakhs. So this is when dividends are paid. Okay, so the value of the firm when dividends are not paid. So the value of the firm when no dividends are paid is rupees 10 lakhs. Okay, now case 2, next case, when dividends are paid. When dividends are paid, case E is 10% itself, okay, and P0 is 100. D1 you have computed, and what is D1 here? D1 is rupees 5 per share. Okay, D1 is rupees 5 per share. Okay, now P0 is equal to P1 plus D1 divided by 1 plus KE, that is P0 is 100 is equal to P1 plus 5 divided by 1.10, or P1 is equal to 100 into 1.10 minus 5, that is equal to 105. That is the calculation. Okay, now what do you have to do? You have to find out what is the funds required for investment. Funds required for investment. Okay, so total earnings E is equal to 1 lakh minus dividend distributed. Dividend distributed is 10,000 into 5, 10,000 equity shares into 5, 50,000. So fund available for investment, funds available for reinvestment, that is equal to 50,000. And how much do you require for investment? 2 lakh. Amount required is 2 lakh. Therefore, balance to be raised, balance funds to be raised is equal to 1,50,000. Okay, now number of shares to be issued. This is nothing but delta N, and this is 1,50,000 divided by P1. What is P1? P1 is 105. Okay, so 1,50,000 divided by 105. Now value of firm. Value of firm NP0 is equal to N plus delta N into P1 minus I plus E divided by 1 plus K. So that is equal to NS 10,000 plus 1,50,000 divided by 105. 105 is 1428.57. So 1428.57 into 105 minus what is E? I is 2 lakh plus E is 1 lakh and 1 by K is 1.10. So that is equal to 10,000 plus 1428.57, 1428.57 into 105, that is almost 12 lakh minus 2 lakh minus 1 lakh, it is 1 lakh divided by 1.10, that is 11 lakh divided by 1.10, that is 10 lakh. So value of firm is 10 lakhs. So value of the firm when the dividends are paid is rupees 10 lakh. So when the dividends are not paid, what was the value? The value was 10 lakh itself, and when the dividends are paid, its value remains the same, 10 lakh. So what is the conclusion? Conclusion means as the value of the firm is same even when the dividends are paid and the dividends are not paid, as per Modigilani Miller approach, the dividend payout does not affect the value of the firm. Okay, so that is the conclusion. You can note it down. So that's all with this problem, and now we will move to the second problem. The second problem is also almost similar to this. Okay, so let me take this here first. One minute. I hope this is clear to everyone. Second question. So let's read the question again. Question number 2. Okay. RST Limited has a capital of 10 lakhs in equity shares of rupees 100 each. The shares are currently quoted at par. The company proposes to declare a dividend of rupees 10 per share at the end of the current financial year. The capitalization rate for the risk class of the company belongs to is 12%. Compute the market price of the share at the end of the year. If dividends are not paid, dividends are paid, assuming that the company pays a dividend and has a net profit of rupees 5 lakh and makes new investment of rupees 10 lakh during the period, calculate the number of new shares to be issued. Use model. So the same problem, nothing different. Okay, so let's take situation 1. Dividends are not paid. Dividends are not paid. So let's do the calculation. So how do you do the calculation here? So first of all, let's see what is N. N is the number of equity shares. Number of equity shares is 10 lakhs divided by 100. So that will be 10,000. Okay. And what is P0? P0 is the share price right now. So they say that the shares are currently quoted at par. So it is rupees 100 itself. Then KE is given to be 12%. Okay. Now, if dividends are not paid, then D1 is equal to 0. Now, what is the earnings? Earnings for the year 5 lakh, and that is E. then investment amount that is I is 10 lakhs. Okay, now what you have to do, like in the previous case, you have to first find out P1. How to compute P1? P1 can be computed using the formula P0 is equal to P1 plus D1 divided by 1 plus K. So what is P0? 100 is equal to, what is P1? P1 to be computed. What is D1? D1 is 0 divided by 1 plus K, 1.12. So P1 is equal to 100 into 1.12, that is 112. So what do you have to do? The number of shares to be issued, number of shares to be issued is equal to, you need total value of 10 lakhs minus how much retained earnings you are having. You have a retained earnings of, your total profit is 5 lakh. Okay, and out of that you are not paying any dividend during the year, so minus 0. So 5 lakh, 10 lakhs minus 5 lakh, okay, divided by, what is the value per share? Value per share is 12. So you will be issuing one share at 112. So that is 10 lakh minus 5 lakh, that is 5 lakh divided by 112, and that will give you 5 lakh divided by 112, that is 4464.26 shares. Okay, that is the number of shares to be issued. Now what you have to do, so this is delta N. Okay, so you got the value of shares also. Now probably you can do the value of firm. Value of firm NP0 is equal to N plus delta N into P1, okay, minus I plus E divided by 1 plus K. So that is equal to, what is N? N is 10,000. 10,000 plus, what is delta N? 4464.26 into, what is P1? P1 is 112 minus, what is I? I is 10 lakh. What is E? E is earnings. Earnings is 5 lakh divided by 1 plus K, that is 1.12. K is 12%, so 1.12. So it is 14,464.26 into 112 minus 5 lakh, okay, divided by 1.12, that is equal to 14,464.26. 14,464.26 into 112 minus 5 lakh, that is 11 lakh 19,997 divided by 1.12. Okay, this is nothing but, if you round off this value, it is 112, 11 lakh 20,000. So 11 lakh 20,000 divided by 1.12, that is equal to 10 lakh. So the value of the firm when dividends are not paid is 10 lakhs. Now case 2. What is case 2? When dividends are paid. And what is the amount of dividend paid? The amount of dividend paid is 10 per share. Okay, so the same question, when there is D1 is equal to 10. It's 10, no, it's 10 per share. Okay, so you have P1 or P0 is equal to P1 plus D1 divided by 1 plus KE. That is P0 is 100 is equal to P1 plus D1 is 10 divided by 1.12. So it will be 1.12 into 100 is 112 minus 10 is equal to P1, that is 102. Okay, so P1 is 102. Now you have to find out delta N. Delta N is the investment value is 10 lakhs. 10 lakhs minus what is the total profits? Total profit is 5 lakh minus dividend paid. Dividend paid is how much? What is the dividend paid? Dividend paid is 10 rupee on 10,000 shares. So it is 1 lakh divided by 102. So that is equal to 10 lakhs minus 4 lakhs, that is 6 lakh divided by 102. 6 lakhs divided by 102 will come to 5882.35 shares. Okay, now value of firm NP0 is equal to N plus delta N into P1 minus I plus E 1 plus K. So that is equal to N is 10,000 plus 5,882.35 into P1 is 102 minus I is 10 lakhs minus this is plus 5 lakh divided by 1.12. So that is 10,000 plus 5,882.35, that is 15,882.35 into 102, that is 16 lakhs 19,999.70 minus 10 lakhs minus 5 lakhs is minus 5 lakh divided by 1.12. So this is 17 lakh 20,000, right? Sorry, 16 lakh 20,000. So 16 lakh 20,000 minus 5 lakh is 11 lakh 20,000 divided by 1.12, that is equal to 10 lakh. So the value of firm is 10 lakhs. So here also if you see, when the dividends are paid, the value of the firm is 10 lakhs, and when the dividend is not paid, there also the value of the firm is 10 lakh itself. So we can conclude that the dividend policy adopted by the company does not affect the value of the firm, as the value of the firm remains at 10 lakhs in both the cases. So this is the conclusion. So far we have done 2 problems on Modigilani Miller approach, and whatever questions we can expect from this particular problem or from this particular topic will be of this kinds. Okay, now we'll have to move to the next model.